about to hear my conversation with Tiffany Zhang, Vice President, ETFs and Financial Products Research at National Bank Financial. Today, we'll explore key ETF market trends in Canada and the US, cross-border ETF investment considerations, and the case for buying Canadian. The discussion will explore where ETF flows are going, what's driving the surge in active ETF adoption, and the tax and currency implications of investing in US-listed ETFs. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. I am your host, Prerna Matthews, Vice President of ETF Product Strategy. Today I'm joined by Tiffany Zhang, Vice President of ETFs and Financial Product Research at National Bank Financial. Tiffany and the team at National Bank Financial ETF Research are widely respected experts in the Canadian ETF space. They're known for their deep research on flows, ETF investor behavior, and product structure. The team produces lots of ETF market-related research, including a recently published strategy note on a practical introduction to foreign withholding taxes in ETFs. Tiffany, thank you for joining the podcast today.
Thanks so much, Prerna. You picked a very good time.
So let's dive right into ETF market flows year to date in 2025, and most recently over the past few weeks. So your team closely tracks ETF flows north and south of the border. How have ETFs held up during the market volatility in early April? Where's the money going in the Canadian and US markets right now?
Yeah, so that's a loaded question. How about we unpack it a little bit, Prerna, and we can talk about maybe ETF trading during this volatile period. And so typically, in volatile markets, two things happen with ETFs. One is that ETF volume, both in terms of absolute dollar volume and as a percentage of the overall market volume, tend to rise. And so we saw some really wild stats for both Canadian and US ETF trading in the past couple of days. So in Canada, on average, last year, we had about $3 to $4 billion of ETF traded every day. But starting from April the 4th this year, we had 4 consecutive days of north of $10 billion of trading every day. So that's 4 times the average daily volume. And in the US, there was a day when we had $640 billion traded in ETF. So that number tells you that investors were leaning on ETFs to tap into the ETF liquidity, and both retail and institutional investors were there. The second thing with ETF during this kind of time is that their bid-ask spread tend to widen out. So are the premium discount. This is to compensate the market makers for taking on additional risk when they are providing liquidity into the marketplace. And we can have an entire separate episode just about premium discount and bid-ask spread, but typically they do widen out during these times. We really didn't see anything that's indicating a systematic failure or anything that broke. And these widened out bid-ask spread already narrowed back into normal range as the markets are becoming much more at ease this week. One thing that caught our eye was the SPY ETF in the US that traded at a historical 90 basis point premium. I believe that's the highest since 2008. And so what had happened on that day, which was, I believe, April the 9th, was that, there were a lot of bearish trades building up in SPY already because the markets were selling off. And then as a tariff pause announcement came out, the markets quickly reversaled and a lot of short sellers had to scramble to close their short positions into the market on close facility, and that caused excessive demand, and that led to the premium. And so, that's, I think, serves as a great reminder that, when trading ETFs, there are a lot of best trading practice that you need to follow. Perhaps avoid trading during the most volatile periods of the day that tend to be usually market close and market open hours. And also use limit orders.
Yeah, great point, Tiffany. Because I was going to raise just that every time we see these bouts of volatility, especially severe volatility, you see the headlines pop up, right? And it's like, are ETFs going to break? This is going to be the moment that'll break the dam on ETFs, and we're going to have significant failures in the ETF market. So just to reiterate. We haven't seen that, right? And you and I have both been in the ETF industry now for quite some time. And we keep seeing those headlines, right? Every time you see
Yeah.
that, you go back to COVID even more recently, right? And the headlines again on what some were fearing would happen, but we didn't actually see that in the ETF market. However, a question for you. We've obviously seen a lot of active ETFs come to market even since COVID, both in Canada and the US. I'd love to get your thoughts specifically on the active ETF market. Are you seeing different behavior in active ETFs versus passive ETFs in those moments? And how have flows generally looked for active ETFs year to date?
Yeah, I think I can first of all echo to a point about how active ETF is very popular, and there's a lot of active ETFs coming out in the market. So in Canada, for one passive ETF coming out, we have about 1 to 2 active ETF coming out. And so that's a ratio is about the same in the US as well. In terms of asset and flows, so in Canada, we have about 30% of total Canadian ETF that's actively managed. And of course, that includes a wide range of strategies. Not only your fundamental active, but also a lot of option strategies, cash and money market, and other, multi-asset strategies as well. And so in terms of flows, it's pretty strong. Year to date, we have about 60% of total inflows that have gone into active ETFs. And so that's twice its AUM market share. In the US as well, the US active market actually developed much later than us. I believe after the 2019 ETF rule, there were a flurry of new launches in the active space in the US. And so now they have about 9% of total ETF AUM that's inactive. And in terms of flow, about 38% of year to date flow that have gone into active ETF in the US. And so that's about 4 times the AUM market share. So also pretty strong. In terms of the market behavior, we really don't see any difference between whether ETF is active or passive. It really depends on the underlying asset class. If the ETF holds somewhat less liquid underlying, such as muni bond or high yield securities, then in these kind of moments, their bid-ask spread will tend to widen out more than others.
Yeah, fair points and great reminders. So let's break apart the active passive conversation a little bit more and get to a deeper level. Are there any particular asset classes, types of strategies that have seen disproportionate inflows year to date, where investors are really gravitating to with current market conditions?
Yeah, I think there's always a steady stream of buying into broad-based passive ETFs, and this year it's interesting. It's no longer just the U.S., which was the theme for last year. This year we see a lot of buying into international developed, into Canada, and single country and regions such as Europe and China. And the reason being that this year the U.S. market actually underperforms the rest of them year to date. And this is the only time since 2018 outside of 2022. And so beneath that surface of steady stream of buying into passive ETFs, we see a lot of demand for active ETFs in the areas of being defensive. For example, we see inflows into low volatility ETF strategies. That's on the equity side. And then on the fixed income side, a lot of inflows into money market and ultra short term cash ETFs. And generally speaking, active bond ETF, right? So active has a deeper root in fixed income than in equity, at least in the ETF space. So we do see flows going that way. And also a lot of multi-asset hedge fund style strategies that are using long and short style. And so these tend to do well in market environment like what we are going through.
Are you seeing similar trends in the US, or is it different in terms of
Yeah,
asset
similar
classes?
trend in the US. A lot of defensive positioning as well there. And on top of that, we have gold bullion ETF in the US that's also getting a lot of inflows, and buffer ETFs in the US. That's also a protection category in the US where advisors use to help I guess, have a defined outcome in a certain period. But I think the US investors, they tend to have higher animal spirits. We see a lot of strong inflows into ETFs such as TQQQ, those like 3 times levered exposure into semiconductors and NASDAQ, but not so much in Canada. But overall, very defensive for both Canadian and US ETF investors.
So, speaking of US listed ETFs, I'm astonished still at how varied the knowledge or awareness is amongst advisors and investors. In some cases, it relates to where you buy your ETFs, whether you buy them off of a Canadian listed or Canadian exchange versus a US listed product on a US exchange. A great time, I guess, to turn back to your recently published strategy note, A Practical Introduction to Foreign Withholding Taxes. Let's spend some time maybe talking about that, unpacking that a little bit for our listeners, because I've definitely found that even some of the more sophisticated advisor teams, this concept and really getting down to the granular level is still novel or not as well understood. So the recent note that your team put out covers foreign withholding taxes. Can you talk to us about some of the key things, key themes, topics that investors, advisors should understand when buying US listed ETFs?
Yeah, so for US listed ETFs, I will mention 3 things. One is that the better place to put them would be in your registered retirement saving plan, RRSP or RRIF, because in the RRSP, the withholding tax from the US side, US equity, US fixed income, actually is exempt. So you don't have to pay anything if you hold US listed ETF in RRSP or RRF. In a cash account, you have to pay withholding tax, but you can claim it back when you file your tax every year, which I believe is still the end of the month. And also in TFSA and RESP, you cannot recover it. So you essentially just lose the opportunity to recover your withholding tax in TFSA and RESP. And so that's the first thing. And the second would be, some of the US listed ETF, they would seem to have advantage compared to Canadian product, assuming all else being equal. And the only reason is that the US listed ETF, they do not have the withholding tax baked into the return. But for a corresponding Canadian ETF, they would. And so, like I mentioned earlier, if you are in a cash account or RSP, where you don't have to pay those withholding tax, then these two should be the same, assuming all else being equal. And so the third thing with US listed ETF is that you have additional filing requirements and then additional tax consequence because US listed ETF is considered US property. And so for high net worth client who might be subject to the estate tax from the US, then the US listed ETF would contribute to the overall value of your portfolio. I believe most recently the threshold is you have global assets that exceed about 14 million US dollar, and the US assets exceed 60,000 US dollar. And also for other investors, I believe you have to file T1135 when your foreign assets in total exceed about 100,000 at any time during the year. And of course, just issue a standard disclaimer, we are not tax experts. And so if you have any tax related advice, please consult your tax expert for confirmation.
Thanks, Tiffany. I'm going to go back to the second point that you made around exposure and withholding tax. I think the example you were giving was focused on U.S. equity. So it'd be great to get your thoughts on how that varies for international equity, for example, right? So U.S. equity, U.S. listed ETFs versus international equity, U.S. listed ETFs, and is that the same?
No, it's not the same. Again, assuming all else being equal, right? So in terms of liquidity, in terms of MER, in terms of trading expense ratio, assuming all else being equal, if we are just thinking about the tax perspective, a Canadian listed ETF that invests internationally into global stocks is much better or tax efficient than a US listed ETF that invests in the same stocks. And the reason is you can claim back your withholding tax in your taxable account with a Canada listed ETF that directly wraps those international stocks, and then you end up paying one layer of withholding tax in your RSP and TFSA RESP account. But for a US listed ETF that invests internationally, you do end up paying at least one layer of withholding tax, even after considering that you can claim back your US withholding tax in taxable account.
Thanks for clarifying that, Tiffany. So we haven't talked about currency and FX. So I think a great time here now to chat about how do factors like currency exposure or foreign exchange conversion costs impact that decision to buy a U.S. listed ETF versus a Canadian listed product.
Yeah, so that's absolutely a consideration because if we are a Canadian investor, we want to invest in U.S. listed ETF, then we need to convert our currency into USD unless we already have some US dollar coming our way. That's a separate discussion. But if we need to convert those currency to the greenback, it's kind of expensive if you are doing it at the retail level, usually about 1 to 2%. And so, what we see some clients do in order to get around that is to use Norbert's Gambit. And so, for that trade, you end up paying at around about 10 basis point, which is the beta spread of the ETF pair people typically use, which is DLR and DLR.U. There's also restrictions on that, right? So whether your brokerage can allow for that, whether there's journaling fee for doing it, so you have to consider that as well. Uh, and if we use a Canadian listed ETF, then we don't have to convert the currency, and also we have the choice whether you want to have exposure to the foreign currency or we want to hedge them back into Canadian dollar. But also be mindful when we think about this, there's also a cost, right? So even as Canadian investor buy international stocks, the market makers are taking care of the currency conversion at their institutional FX rate for you. So that would be much cheaper though compared to you doing it yourself at the retail level. So cost is definitely a consideration when investors think about whether to use Canadian listed or US listed products.
Thanks, Tiffany, for entertaining my somewhat deep questions on the nitty gritty of how this sort of withholding tax consideration can be thought of by advisors and investors. So let's pull it back up a little bit and put it in context again of our listeners. When does it make sense for Canadian investors to stick with a Canadian listed ETF rather than looking south of the border?
Yeah, so we mentioned a few different account types and different client types. And so, for example, for a client who is subject to, maybe a lot of Canadian dollar obligation, right? If you need to pay property taxes or your hydro bills in Canadian dollar, perhaps stick with Canada listed ETF instead of having to convert your currency and always get exposed to the USD CAD exchange rate. And also, I think a global exposure, we talk about how Canada listed ETF is much better in terms of tax compared to a US listed ETF, all else being equal. And lastly, I would say, in the area of option income, Canadian ETF also has an advantage because the option premium from call and put writing is treated as capital gains for Canada listed ETF. However, if you buy a US listed ETF, the option premium will be treated as foreign income. So that will be much more punitive than the capital gains distribution.
Okay, yeah, so great point. So there are potentially some tax and efficiency considerations. Anything else that you haven't mentioned yet in the tax and efficiency that might be relevant to our listeners to consider for a Canadian listed product?
I mean, it depends on whether you want to get a foreign currency exposure, right? So that's also another consideration. We've seen different camps of different views. For example, for gold, um, we have investors coming to us just asking for currency unhedged gold exposure, and that's really because they believe that the gold commodity is apocalypse insurance, and so in that case, US dollar and gold price tend to move in parallel. And so that would tend to do well in those really extreme market environments. And we have also other investors who come to us and say, we want pure gold bullion exposure. And so in that case, we want to strip out the USD currency impact on my gold investments. And so in that case, they would use currency hedged ETF, right? And also for fixed income, I think a lot of Canadian investors would want to prefer to have currency hedged fixed income exposure, because otherwise your FX exposure volatility may overwhelm your fixed income exposure's volatility. And so if you are using a US listed ETF, then you probably in the case of fixed income, you don't really want to have that FX return show up in your statements. So it really depends on the investor preference and what kind of exposure and asset class that you are looking to buy.
Really great tips and suggestions, Tiffany. As we wrap up our conversation today, an important question and an important one, particularly in our political climate today. But with the increasing number of Canadian ETFs on offer, 1,500 plus, almost 1,600, I think, at this point in the Canadian market,
Yeah, almost 1,600.
do you think more investors are or will be shifting toward homegrown investment solutions versus US listed products?
Yeah, we have definitely seen a sentiment around using Canadian products this year, particularly after the tariff. And I think that, talking about all of these currency implications, this, different tax implications, using Canadian ETFs, I think that would be an easy first landing spot for any Canadian investors. Having said that, I think it's always an open competition between the US and the Canada. We saw that with crypto asset ETFs, right? So actually, Canada has a 3-year jumpstart for crypto asset ETFs. We had the first physical crypto ETF in 2021, and the US had their first last year. But after the US products came out, we actually saw a lot of flow going into the US ETF from Canada, because the US listed products are just way more cheaper and much more liquid. And most recently, I believe at least two ETF providers in Canada have lowered fees to match the US products. And so we have seen flows come back to Canada again. So there's always a competition going on. But I think what at the end of the day will matter is that, the innovation. If we have a lot of innovation in Canada, we can provide the investors what they need in a very efficient way, in a very low cost way. So that will really help investors stay invested in Canada. And I think we are getting there. In Canada, we have, like you mentioned, Perna, we have 1,600 products. We have 45 ETF issuers. I think the path of least resistance for the industry is to grow and is to scale. And so that ultimately will benefit the investors via, lower fees and better products and more innovation.
And I have no doubt we will continue to see a lot of innovation out of many, many ETF providers here in the Canadian market. Tiffany, thank you for sharing your insights today. It's been enlightening to unpack the ETF trends and explore how investors can truly and properly assess US and Canadian domiciled ETFs for their different accounts within their portfolios. That brings us to the end of this episode of The Invested. Thank you to our listeners for tuning in. We hope this episode has provided you with valuable insights on how ETFs can be used in your portfolio construction. If you have any questions or topics you'd like us to cover in future episodes, please reach out via our blog or through LinkedIn. Until next time, stay invested. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income tax payable by any security holder that would have reduced returns.